bring in Klaus Baader with decades of expertise. He's leaning over, getting his beverage of choice in London. Klaus, great to have you back. We appreciate you coming in today. Klaus, we've seen a terrific equity market in the United States, sigh of relief, Greece refunded. Just let me ask a simple question. I think I know the answer. Is it all clear for peripheral Europe?
No, it's not, but it's clear for the moment, I think. It's clear insofar as that Greece is effectively getting another chance. They are making another effort to get with the program, because that's, of course, been the problem. And so an imminent default risk, which couldn't be completely discounted, has disappeared. Now, I think in the case of Greece, you have to differentiate between the various peripheries. I think in the case of Greece, the next test is already on the horizon, and that's the September's examination by the Troika, if they are now finally meeting their targets. And so the nervousness is going to return, but I think it's kind of clear for the summer. Right. And for the next few months, we've stepped back from the abyss. But of course, once again, we've only addressed the funding issue rather than the solvency issue.
Klaus Baader, from an economic standpoint and folding it into investment, do you look at Europe in the aggregate, or can you make a partition of developed, healthy Europe and unhealthy Europe in the periphery? And can you invest and think about the two separate, or at the end of the day, will it coalesce as we go to 2012?
Oh, that's a very good question. I mean, I think that equity investors have never really bought into the euro area the way fixed income investors have, because equity investors tend to look much more at either individual companies, but of course they look at individual markets, and the stock indices in Europe are still national indices, largely. There are some pan-European indices, but the main market indices are national. So it was the fixed income investors which really looked at Europe very much in the aggregate. But now we know that we made a terrible mistake in effectively over-aggregating, and when country risk returned and spread suddenly became significant again, the whole thing fell apart. So no, I think that we do have to look at Europe quite differentiated, and I would actually say we need to look, even in terms of fixed income markets, we need to look not just at the core, what you call the healthy core, and the somewhat sickly periphery. I think we have to really differentiate between the periphery. Right. And you know, it's been my stated opinion for some time that the concerns about Spain are really vastly overblown. And I would actually also say that the concerns about Portugal are probably a little bit overblown, particularly when you compare it with the valuation of risk around Ireland. It seems to me that Ireland has gotten away with things that the other periphery countries wouldn't have come away. Sorry, that was a long answer.
Well, we like long answers. That's good news. It's hot there. So you can, dab your face as you want. I do that all the time. Klaus, when we look at I lost my train of thought. 3, 2, 1. Okay, there it is. Klaus, when you look at France, you have a killer chart in your report of French exports to the euro. Obviously, we're focused on France today with this drama with the former head of the IMF. Tell us whether France right now, they're nowhere near the recovery like in Germany, are they?
No, they're not. But I think in the case of France, you really have to take account of the fact that France had a very shallow recession. The French economy didn't experience anything like the drop that was experienced in Germany. And so this very strong growth in Germany over the past 2 years, and in fact, last year Germany grew 3.5%, and we think it's going to grow very close to that again in 2011, a remarkable turnaround for what was regarded for a long time as the sick man of Europe. France just doesn't have that recovery potential, simply, but that's in part because they didn't experience as deep of a drop.
Right.
But the French economy, looks it's not as exciting in the rebound, but it was fortunately also much less exciting in the downturn, and I think that explains a fair amount. But France historically has reacted much more in its exports to the US dollar exchange rate, the euro dollar exchange rate, than Germany has. And that has to do with industrial structure. It has to do with a lot of things, and also with the very high levels of non-price competitiveness that German export goods enjoy. In that sense, German export goods are a bit special. Nobody buys them because they're cheap.
That sounds good. Klaus Baader, thank you so much. Societe Generale